Welcome to the Nalu Finance Podcast. In this episode, we dive into the world of private mortgage and bridge loan investing, a space that blends real estate, lending, and income generations. Our guest is Reed Myers, principal and owner of Myers Capital Hawaii and Myers Investment Group, who has built a reputation for offering investors access to income-generating mortgage opportunities. Reed shares how private lending works, what makes Hawaii real estate market unique, and how investors can participate in these asset-backed strategies. We'll discuss everything from risk management and default recovery to expected returns, liquidity, and who these opportunities are best suited for. Whether you're an experienced investor or just curious about alternative income streams, this episode will give you a practical insight into how private mortgage investing really works. Reed, you have built Myers Capital into a specialist in private mortgage and real estate lending, and Myers Investment Group as an investment management company offering passive mortgage investments. How did you first become involved in this space, and what market gap did you identify?
Yeah, great question. Thanks, Devin. I first got started in real estate and finance out of college, actually. So I got recruited to work for a small real estate investment trust in the Carolinas. And so that was kind of my first foray into real estate, finance, some development. And then shortly after that, I came on board with my family company, Myers Capital. My father started in 1998. So I kind of think it came on board. This is post or right around the Great Recession, and a lot of our deal flow at my prior position was starting to get iced over, and a lot of capital started to dry up. So my boss actually took me to the side and said, hey, we love having you here, but you might want to find another opportunity because we don't know how long this is going to last. So kind of took that as it was, and I learned a lot from him. He was actually the chairman of the company. And so I came on board with our family company thinking it was going to be temporary. At the time, we were just a very still small today for many respects, but a commercial mortgage banker, primarily doing commercial lending for small apartment buildings, mixed use, things like that throughout the Carolinas and the Southeast. And I used to help out actually in the summers, actually during high school, and never really enjoyed it. So never saw myself wanting to get into the business. But as an adult and kind of getting the experience I did working for the REIT, it really started to stick with me. But there was a caveat to it. I had to pretty much start from the bottom and work my way up. So there weren't going to be any favors given or anything like that. So I actually started off loan processing, doing some underwriting, taking loan applications for, the basics. And that gave me, I felt like it was a great foundation. At the time, I was like, why am I doing this? Why can't you just put me in this type of position? But looking back on it, I respected, the route.
Yeah, but that way you learn what to look for. When it comes your way, you can probably very quickly spot certain patterns that you would have never known if you would have not done that.
Yeah.
So for the listeners less familiar, what exactly is actually private mortgage lending and how does it differ from traditional bank lending?
So private mortgage lending is one part of our business. So we actually do other types as well, but that's the purpose of a topic of conversation here. So private mortgage lending is basically outside of the institutional realm. So these are typically loans that don't require all your typical conventional requirements that much like you would think of a bank requiring. Less contingent on cash flow analysis, more based on the asset. Some people can call them hard money loans, private money loans. Different parts of the world call it different things, but basically it's just less conventional. So less emphasis on FICO scores, although we still look at them, less emphasis on cash flow, more on the underlying asset itself. So that's underwriting. Right. It's kind of a conundrum because you would think that, well, underwriting is going to be easier than getting a conventional long-term bank loan or Fannie Freddie agency loan. It is, but it isn't. So it's a balancing act because we are taking on more risk and therefore our yield is much higher. Interest rates are much higher. We still need to be very particular about how and what to lend on. So we'll touch on that later, but it really, in my opinion, it's about deal flow, having good quality deal flow, the ability to say no, 75, 80% of the time and pick the top 20% that you like.
Well, okay, that's your ratio. Interesting. You talked about where you learned it in the Carolinas, but you are now located in Hawaii. Sort of what makes Hawaii real estate and credit market unique, and how does sort of shape your lending strategy?
Yeah, so about 15 years ago, I was actually born in Hawaii, so that's kind of my drawback to Hawaii. And I know you and I chatted offline a few times about our connections to Hawaii. So that was kind of my impetus to move back. Is hey, why? I could kind of see where things were going. That you can do more and more things remote, even 15 years ago. And say, well, Hawaii's got a great real estate market. Plus, I would love to live there. So love to kind of go back to my roots. So I took a chance. It was a big chance and opened up a branch out here just by myself. And unfortunately, we grew it and we've been very successful. So yeah, so Hawaii is a very unique market. A lot of people still call it, if they're calling in from the mainland, as we call it, they say, "Oh, do you guys lend in the states?" And say, yeah, we're a state. It's not a we're not even a territory. We're an actual state. But there are, yeah, exactly, yeah. So, but yeah, the market is very unique. Everything, especially at the level that we do it, it's very boutique, very creative, very opportunistic. You have to know your markets and know when to scale back on kind of your offerings as far as leverage and things like that. But Hawaii is unique. Obviously, it's a smaller market. It's kind of one of those areas where you it gets passed up by a lot of the bigger companies, the bigger institutionals. You can see that very clearly in banks. Banks
I think
here,
it's completely underbanked, Hawaii.
yeah, it's too small for the big guys to come in and I don't really track the entire banking world, but in my opinion, it's kind of the embedded incumbent Kamaina families or old missionary families, brought down through the generations. But they definitely have a foothold. So out here, yeah, you really have to understand the market. You have to understand the culture, how people work, how people think. But real estate specifically, obviously, we're a high cost market. Land is hard to come by. Yep. Development costs are high and long winded. You're looking at extraordinarily long time frames to get things done if you can get it done, and very political. So fortunately, we're not really involved too much on the development side, other than just smaller type deals, single family homes, some small apartment complexes that our individual investors want to renovate. So they're not building 200 unit high rises or anything like that. But the key thing is understanding like your time frame for getting projects done, your cost factor, the marketability, of course, and then your ability to see the project through, knowing that a lot of the value is going to be in the land. So which kind of leads us to some of our targeted asset classes. We actually are one of the few debt funds that I'm aware of that I actually lend on land in Hawaii.
When actually capital investors invest with Myers investment codes, what actually are they investing in then? Is it the mortgage itself?
Yeah, yeah, great question. Yeah, so basically, so we have two different sides of our business, right? We have our clients are our borrowers, that come to us, and these are typically real estate investors, maybe some small developers, builders, commercial property owners. And the other side of our business is managing capital for capital investors. So you can participate as a capital investor into any of the deals that we put out as an offering. Basically, when you do that, we assign the mortgage or the first trust deed. Those are generally interchangeable, just terminology depending on the state. But basically, easiest way to think about it is you can participate as a lender. So when I say participate, you can acquire a portion of the mortgage or the entire thing. And this is done typically through a fractional agreement or just a full-on assignment of mortgage.
What is a first trustee, and why is that important from a security and risk standpoint?
Yeah, so basically it's a mortgage. So you got to look at it from a lending standpoint. It's basically an asset to whoever owns it because it provides an income stream. And then
Is it a transferable asset?
it can be, yeah. Yeah, I mean, you even see it with consumer mortgages, but you don't always see the underlying transferring. Sometimes you might just see servicing transfer rights, but ours is a little bit more straightforward than that. But yeah, basically, you can invest into a particular mortgage, and that will provide an income stream at a certain rate of return, assuming the borrower makes their payments. But the big factor here is reduction of risk by it's fully collateralized against an asset that we valued at a certain price, right? So, and we're talking real estate. We're not talking equipment. We're not talking automobiles. We're not talking, simply a PG or personal guarantee. This is collateralized by a very hard asset. And in the investing world, arguably what's more safe than real estate in a good
Yeah.
area.
And I mean, leads me to my next question is how do you actually assess the value or the loan to value, or the value of the underlying, and what's sort of the typical range for loans in your portfolio?
Sure. Yeah. So basically, I mean, we almost always will get a full appraisal, either done by a licensed appraiser or MAI. That it doesn't stop there because you still need to understand the comps that go into it. Not all appraisers are equal, and not all are experts in certain areas. So it still takes another set of eyes to look on and say, like, why are these comps being pulled? Why wasn't this and this and this brought in here as a consideration factor when putting together your value? So they still need to be checked, and that's kind of where our experience comes in, is looking at, well, are these comps are like real comps, and we can always make, because we're the lender, we can always make adjustments. Say, I know this came back at $3 million, but because of this and this and this, and we look at the entire deal itself, we can easily dial back our LTV, loan to value, and what we're willing to lend to this particular bar for this particular situation, deal by deal. And we do that. So it's just kind of looking at the entire picture. But yeah, you got to take everything with a grain of salt, right?
What kind of returns sort of can capital investors typically expect from private mortgages or trust deed investment today? You said it's higher than other ones, like let's say the bank mortgage.
Yeah. So these are obviously, we're foregoing traditional institutional underwriting guidelines for our own, and this is the private market. So basically, we set the yield at what we feel the market can bear. At the same time, it's not about just maximizing yield no matter what. It's about finding an equilibrium between what a good borrower, and define that, right? A good borrower, a good deal, what can take, if it's a great project and we really like it, then we can get more aggressive with the rate. But usually we see the market being able to bear, at least in Hawaii, well, I mean, we lend in other states as well, but on average our note rates are anywhere from like 13 to 14% on average. These are for typically first lien positions. So yeah, those are the yields that we're currently able to obtain. There might be some adjustments should interest rates drop, but generally over the years, this kind of lending will capture double digit yields on real estate.
Is there much difference between shorter dated bridge loans and longer term trust deed position? Is there significant difference?
Well, we're only doing with this type of lending, we're only doing short term, so it's 6 to 12 months on average, or about 12. So it gives us a lot of flexibility to kind of reassess things. So sometimes our borrowers might need to extend, or we might, if we're comfortable, we write it up for another 12 months. But we usually like to write them up for 12 months at a time. That gives us the option to say, like, if the borrower is not performing, if this and this, or the market's turning and we don't like it, we're gonna issue a default, and they'll need to quickly, figure out a way to pay us off. But yeah, on the other side, if a borrower is making their payments religiously, they've been very communicative with us. So we keep all these loans on our books. So, and we're servicing it in house with the help of a subservicer, professional subservicing company. But we're very much involved. I mean, our controllers and even myself sometimes will reach out to borrowers on a monthly basis saying, "Hey, how are things going on?" Even after we've closed on the loan, right? So it could be checking in on the progression of the project, just trying to get a sense of where things are at. So the communication and that relationship that we build and maintain, and that continued communication after the loan closes, is incredibly important. I can't stress that enough. Yeah.
What are sort of the main risk factors investors should be aware of, and how do you try to mitigate them?
Yeah, so that main risk factors are going to be, obviously, I guess a higher level, you want to look at who your operator is. That would be who's putting these deals together. What's their track record? What's their mindset? What's their culture like? How do they like to underwrite? What makes them different? What areas they like to lend in? That's kind of the first step, right? As a capital investor, is just understanding who your operator is. Beyond that, it gets a little deeper into underwriting. Once you've identified what kind of operators you like and it seems to fit with your investment goals, then you start to dial in a little bit more on underwriting. So depending on your experience level and what you know about mortgages or real estate, I would say, everything's about education. So bring as much of your current background and what you know about investing in real estate and ask hard questions. I mean, for us, like, risk factors are obviously a borrower may not make their payment, right? They might have some liquidity issues. They might have a delayed back to development, right? Even if we're not doing development deals that much, we might be talking about, well, what does it take to renovate this property? How accurate are those numbers? So the borrower tells us these things we need to verify while we're underwriting. Market shifts, right? What's happening in the local area? How is the market performing, or how are things shifted since we originated the loan? But yeah, risk factors. There's always risk in investing and in lending, but we feel very secure in where we're at in the capital stack and our
So
LTVs.
what happens if a borrower actually defaults? I mean,
Yeah, it can. Our average loan to value across our portfolio is about 50 to 60% right now. So, our average loan amounts, anywhere from maybe 600,000 to $1 million. So we play in this kind of low balance for Hawaii, very more low balance commercial kind of arena. And the way the process works is typically, we issue default, we start to engage our attorneys, litigation attorneys, file the appropriate paperwork. There still needs to be communication with the borrower if they're, open to it. Because sometimes we find ourselves where maybe we just negotiate a deed in lieu and save all of ourselves a whole lot of time, energy, and effort and costs, saying like, look, this deal is not working. You're obviously not able to make the payments, and let's try to clean this, make a clean cut from where we're at right now, and we both move on, and it becomes a win-win. That's the key.
what are some of the early warning signs that a borrower or property might be in trouble?
Communication is usually where it starts. That's part of like our hands-on.
If they go silent, you mean?
Yeah, I mean, and these are things that we try to pick up on as much as possible up front too. How responsive is the borrower? How open are they? How transparent are they? So we have multiple meetings with them, either in person or over Zoom or over phone, and really try to get into like, the psyche of the borrower and how open are they about things. So we have ways of doing that, questions we ask, how we ask them. It's kind of psychological,
Yeah, I know what you mean. One common question is always with sort of, let's say, call them alternative investments, is how liquid are these investments? And if needed, is there a way of exiting early? Do you sometimes buy them back from investors, or how does this work?
Yeah, so there's a couple different ways you can invest with us directly. One is you can participate in a direct deal. You're a little bit more tied to the hip in that regard. You're tied to that specific deal. Either you own the entire mortgage or a fraction of it. The other way is through a fund model, which, and you and I chatted about this. I can't publicly talk about it because it is a private fund for securities regulations. But either way, same concept applies. I had the same conversation, same question with another capital investor yesterday. Say, well, how liquid is this? If I had to get out, what are the options? So number one, it's important to, don't invest money that you're going to need anytime soon. Now, with that being said, this is not going to be, we call it semi-liquid. So it's not going to be obviously as liquid as your capital markets, your publicly traded securities. It's going to be more liquid than real estate itself, as far as ownership goes. And yes, and generally the terms are, like I said, 12 months, right? So you're already looking at more or less a defined time frame, but you need to be a little bit flexible with that in case something were to happen. But not always, but usually in that case, even if you had to take back a property, it can be a bigger payout, as far as you might even have a windfall. But semi-liquid in the sense that is short term, semi-liquid in the sense that there are note buyers out there that may be willing to buy this note from you if you had to get out, including us. So we've stepped in, and if we had a good capital investor that we had a good relationship with, a lot of these times when we bring these deals to market, as far as an open opportunity, we've already lent the borrower the money, so we already have it on our books. We're comfortable keeping it. So we've already put our money where our mouth is. We don't mind earning the return on it. We have no problem doing that, but it doesn't help us build our added capital base. If we can sell off a portion of this note or assign this mortgage over to an investor, we can free up capital and do more deals. So that's kind of goes without saying, right? But if we had to step in and take back a certain portion of it or the entire thing, we've definitely done that before. So it just kind of depends, but it's semi-liquid in that sense. So don't put money where it's going to be anytime.
I mean, if I would come to you and say, I want to invest in something, what's sort of my minimum investment size?
Yeah. So minimum investments, investing into a first trust deed for us is 150,000. You do need to be accredited. So that of course means you have $1 million net worth, excluding the equity in your primary residence, or have the appropriate income qualifications. It's my understanding too, there's kind of a safe harbor, if you will. If an investor invests 200,000 or more and they provide certain affidavits, they don't need to be verified accredited. SEC, I believe, again, check with your attorney on this, but from my understanding is you considered accredited in their eyes, yeah, just based on the dollar size, yeah. But generally, we want to work with sophisticated or accredited investors regardless, because this is not for everyone. Yeah.
And if I wanted to take a whole mortgage on, in a sense, that is usually what sort of the minimums where this starts.
It just depends on the size of the mortgage. So, yeah. And we had one recently where we had an investor take over a $735,000 note. That was the entire note amount of the principal on the note. So, yeah.
But you stay with the investor, you manage and help them with the reporting transparency. It's not like once it's off your books, they're on their own.
Correct. Yeah. So we're full service in that we're not out of the picture even if we assign it to you. So we manage everything basically after assignment. We're still going to continue to manage it and service it the same way we were doing prior. So we're still collecting the payments. We're still distributing, doing the waterfall and the splits. And we are still actively involved in the borrower's project, how it's progressing, especially if there's construction involved, managing those construction draws, which a lot of times we hold back. These are called construction holdbacks. We hold back construction money and disperse it appropriately throughout progression of the project. So, but yeah, we're there from start to finish. We also handle and manage any defaults and foreclosure situations as well.
And for someone considering maybe to start this, into this, what's the right way to start and what should they look for?
I would say, start by scheduling a suitability call with myself, and we kind of, talk story, as we call it here, just a way to get to know each other, understand capacity, make sure it's a good fit. And, and I like to identify, hopefully up front, like, is this a good fit or not, and why? And, I've turned away investors, not because we don't, couldn't use their capital, but more of, I can see their goals. And I come from a very consultative approach because we help homeowners in Hawaii even purchase homes and even first-time home buyers. Different side of our business, obviously, but I want to make sure things are a good fit for people from the start. Because just like we try to feel out our borrowers, you get clues on things like, okay, yeah, this is great. This could work very well. To me, my clients, both my borrowers and my capital investors, are everything. To me, that determines the health of your company, your credibility, everything. But we want to be aligned as far as our culture and what we can actually provide and what we can't. But yeah, it starts with a suitability call. So.
Excellent. And sort of, you're in Hawaii. Where do you sort of see the real estate market evolving? It's always it's always a bit disconnected from the mainland. I always think about it.
Right. Yeah. I mean, Hawaii's always been number one, a high cost market. You have some lower cost areas like the Big Island, the actual island of Hawaii, whereas islands like Oahu, where I'm at, Kauai, Maui, they usually considered very high cost. Big thing right now going on is kind of the pushback on tourism, which is concerning in a way. However you feel about it politically, obviously we're not going to get into that, but more about like what effects does it have on real estate. I mean, certain parts of Maui are taking hits dramatically. Most of the commerce is on Oahu. This is where most of the jobs are, highest population, and some of the highest costs across the islands. But at the end of the day, there's not enough inventory. Kind of similar song to a lot of places. Development is muted, difficult, and there's always a lot of pushback with it, but we also need it to provide additional housing or affordable housing. At the end of the day, there's still quite a bit of demand for people wanting to, across all income spectrums and net worth spectrums, to acquire assets in Hawaii. It's considered kind of a safe haven in many senses. So I don't really see that changing anytime soon. What Hawaii isn't is a strong cash flowing market. Hawaii is a strong appreciation market, a good way to store capital, store assets into real estate. Appreciation is very strong, very stable for the most part. You can look back at multiple cycles where we've had, minor dips compared to other high cost markets on the mainland. So it's still a very, solid place to store value.
About you, maybe a little bit, if that's okay. I want to ask you a couple of questions about what drives you, something about yourself that most people don't know.
Yeah. Yeah. Well, I mean, for me, like the important thing is like having my name on the door. Everything comes back to me for better or worse. I don't see myself ever getting out of this business. I've always had a passion for capital and real estate investment, and I love building my business, growing it, improving it over time. We still like to stay very boutique. We're a small team, but we've been around a long time, have a lot of experience. But I'd say like the biggest thing what drives me is just, client relationships, client satisfaction, helping people with either growing or preserving their wealth, helping people get started into real estate, especially in Hawaii where it's very difficult, and kind of just parlaying what I know about real estate, what's worked for me or some of my other clients who have been successful, and how this could help you. So that's, that, and just providing a good life for myself and my family, as well as a place for, my staff and my employees to grow and better themselves as well.
A question I always like to ask, I don't know if you have that, but do you have a favorite sort of finance book or business book that left a lasting mark for you?
Yeah. Yeah, I was thinking about that. I thought you might ask something like that. So, I was thinking about it last night. As I was sleeping, just, what really speaks to me, what's changed over time. In the beginning, I would get very granular and really want to analyze and research more and just go deeper and deeper down a rabbit hole as far as finance and capital markets and real estate. And, that kind of led me to like, I almost had my appraiser's license at one time, thinking I really liked the analytical side of things. When I got into a point where I was a business owner, things really evolved for me. So it opened up this whole other world that is so dynamic. It's not knowing more numbers or more nitty gritty, at least in my position and what I enjoy. I've found to really love building and owning a business and everything that comes along with it. So I was thinking about that. I read a book and I found it here on my bookshelf. I read it in 2019. It's an older book. It was published in 2008, I believe. So it's called Street Smarts, and it's by Norm Brodsky. And in the book, it's more about entrepreneurship and running a business and things to be aware of. So I got a couple bullet points here that really kind of spoke to me. So number one, cash flow is everything. Number two, knowing your numbers. So that's still, granular, but you still need to be aware of that. And then this one really speaks to me. Is never falling in love with a deal. So, and you can apply this to both, business partnerships as well as an actual real estate investment deal or borrower. And I have people approaching us all the time. Hey, you should get into this. Have you thought about expanding into this and this? And it looks great. And you never want to let the emotion take over. And, same thing with like trading stocks or getting emotional with any kind of investment. Never falling in love with a deal, knowing and being cognizant and aware of when to say no or when to say no, right? That's incredibly important.
No, I remember coming across that book. I have not read it, but I will. It's going on my book list now.
Yeah.
And last question is, what do you do? I mean, you clearly work and you're very committed to your business, but what do you do in your spare time outside work?
Not a whole lot of spare time. Yeah, I've got two young boys. Yeah, 4 and 8 or 5 and 8. So we're busy a lot with baseball and school activities, things like that. Yeah, yeah, my wife mostly. But yeah, like obviously, we're in Hawaii, so enjoying what we have here, hiking, I don't do it as much as I'd like to, but I mean, there's just some beautiful areas just right in our backyard. And we were talking about, you and I offline earlier about Hawaii real estate, and there's different parts of the island. One is Lani Kai. You've got, beautiful pillboxes there. You've got the whole Ko'olau mountain range, just world class, you know, un, unrelatable views. It's just like, it just blows your mind. And still to me today, been here so long. So just, taking time to step back and absorb that and be fortunate and feel grateful for what we got and where we're at. That drives me too.
Okay. No, Reed, thank you very much. Very much appreciate it. Thank you very much for coming on to the podcast.